I think the other reason that people are asking for curated portfolios is because they want access to sectors which are largely underrepresented in larger indices, and which will create disproportionate value.
Hi Ashish.
Hi Vikas, how are you?
Yeah, all well. How are you doing? Can you hear me?
Very good. Oh, yes, can you hear me as well?
Yeah, all well. So welcome to the AIF and PMS Conclave 2. This is the session where we want to educate and empower investors, and there has been a lot of requests which has come that they wish to know more about one, what is happening in the real estates, and therefore I had Mr. Sharath before you who spoken about real estate market, and then of course the private equity, which is very close to most of the investors' heart. Yesterday we discussed about the overall the allocation of especially the ultra HNI families. And when I say ultra HNI, essentially I'm saying $30 million and above. Those investors have shown a lot of interest towards private equity. So this is the first private equity session that we're going to have, and we were eagerly waiting for your session to come in. What I'll do is I'll quickly introduce you for the benefit of our audience and myself, and then quickly we'll start. You will share the presentation?
Yeah, let me just do
Okay,
that.
all right. So while he's sharing the presentation, let me have the privilege of introducing Ashish. So
Can
Ashish
you see
joined
the
us.
presentation?
Yeah, sorry.
Can you see the presentation? Apologies for.
Yeah. Very much. Can you just scroll down and see if the slides are moving or not? It's moving in very well. Okay,
Okay,
great.
okay.
All right, so let me introduce Ashish quickly, and without any further ado, we'll quickly go to the session and read his mind. So Ashish joined Axis AMC in 2022 as a director private equity to build and strengthen the firm's private equity vertical, basically, and venture capital investing capabilities. He has over 2 decades of professional experience, out of which 12 years have been in growth private equity and late stage venture investing. Prior to joining Axis AMC, he was the global co-head for equity investment in healthcare, food and agri, and consumer at CWC, now British International Investment. Earlier, he was director and country head for India at AIF Capital, an Asian growth private equity firm. Ashish began his professional journey with KPMG in India, and later Goldman Sachs in UK. Across his widespread investing career, he has worked through the life cycle of PEs and VCs investing of fundraising, deployment, and exits, and has worked extensively with portfolio companies as a board of director or an observer or a mentor to the strategy, growth, expansion, fundraising, strategic sales, and listing. So he's a chartered accountant and MBA from Indian School of Business, Hyderabad, and he's also part of the dean's list out there. So without any further ado, I would hand it over to Ashish. All yours, and over to you. Thank you.
Thanks, Vikas, for the kind introduction and for organizing this. As you mentioned, I lead the entire private equity and late stage venture business at Axis Asset Management. And for us at the AMC, building alternatives and within that, building private equity is a huge focus area. And that's how I came in a couple of years ago to build this business. My career, for better or worse, has only been in private equity. So that's all I understand. That's all that I've done. And at the end of the session, happy to take any questions. Now, however I structured this, I think in a lot of meetings over the last 2 3 years with as you said, Indian family offices, HNIs, and even institutions, there have been multiple questions on how do we start our journey on private equity alternatives, right? And there have been questions on both. Why should we invest in this asset class? I think some people are still sort of on the sidelines on trying to think through alternatives. And then for people who've crossed over, I think the question that comes is, how do we start? How do we think of where to start the journey? How do we select the right fund manager? So what I'll try and do is, over the next 20 minutes or so, I'll cover a few of these topics, and then, as I said, open up for questions. So I think why alternatives to some extent has become a no-brainer. If you see, this is an asset class which in the West has existed for many, many decades. But the the interest really surged after the global financial crisis. Um, and it's an asset class which is now, it's estimated to be about $16 trillion globally. So it's a very mainstream asset class. And even in mature markets, it's growing very, very rapidly. Okay. You double click on that and come to India. India alternate assets have grown at about 26% CAGR over the last 5 years. So, that's healthy growth. And just the PMS AIF industry, and I'm sure, there are sort of more recent estimates of this also is, estimated to expand to a very high number by 2028. But why are people looking at this, right? I think as investors get more sophisticated, uh, they are looking for flexibility to create more customized portfolios. They're getting more knowledgeable. I think data is now widely available. Information is a lot more readily available in terms of quality of information. The time that it takes for information to reach, and also dissemination and the level of dissemination that happens, and people are using that to demand more flexibility to create customized portfolios. I think what is also happening, and I'll come back to this point, is sophisticated investors want to participate early, right? And again, developed financial markets have taught us this, right? There are newer and newer companies which are coming up and creating a lot of value for investors. And a lot of that value keeps getting discovered as they come closer to market or after market, right? And what do sophisticated investors do? They try and move a stage earlier to get a participation in these assets and to try and capture a greater portion of the alpha that's being created. I think the other reason that people are asking for curated portfolios is because they want access to sectors which are largely underrepresented in larger indices, and which will create disproportionate value. Today, if you look at a typical, large cap dominated portfolio, right, it'll give you maybe 30-35% banking, it'll give you 30-35% IT, and what sort of large cap IT. That's not where new economy value is being created, right? So people uh, are saying that, look, these newer sectors are underrepresented in our portfolios, and we need more customized portfolios and customized managers to go and tap the disproportionate value that's being created by new companies that are coming up. Okay. Uh, I think, as I said, now within alternates, if you look at private equity, right, and these are just stats, some stats which again help people understand the size of this market, because there's often a question on, how many players, what's the size of the opportunity, am I too late, too early, etc. Okay. Uh, as I said, sophisticated investors want to enter good assets early to capture disproportionate value, right? And if you see, uh, very large number of companies and large size companies are now coming up the chain, right? So there are about 550 companies that got listed over the last 5 years. And there are about 100 of these companies which are already small caps, and some of these are mid caps, right? So newer companies are coming up and they're creating more value, they're larger in value. And as you know, corporate, mortality life cycles are also sort of are condensing. So you're seeing new companies displace older ones. Uh, from a size of opportunity perspective, if you see, there's close to 9,500 PE funded companies, and there's another 16,000 VC funded companies in India. Now, will all of these, become these small caps? No, and that's where the role of sophisticated managers comes in. But there is now a very large ecosystem of these opportunities which has been created, and which is generating great interest amongst investors. I think more importantly, if you look at the stat on the bottom right, like Indian companies are expected to raise about $20 billion of capital over the next 20 years, right? So even from a demand of capital perspective, this is a very, very large market, and that's what's generating interest with the investors. We'll move forward and double click on uh, you know this point around investors wanting to enter early, right? And what we've seen is, for most people who are trying to begin their journey on alternates, right, and then there's obviously multiple options that are available. There are angel funds, there are venture capital. Within venture capital, there are people who are doing early stage venture capital, mid stage, late stage, growth equity, and then pre IPO. Now, a lot of people tend to like this idea of growth equity, and there are reasons to do that, right? Which is, you get some semblance of a business which has been in existence for a few years. You get a business which has hopefully been through a couple of cycles. You're not just investing in a team, and you get faster path to liquidity when you're tapping such opportunities, right? And then the question comes, hey, when people have entered these future champions, you know, early, what have been the returns like, right? So we looked at a few companies which raised private equity from, various private equity or venture capital participants at different stages of time before their IPO. And just for convenience, we've spread this up into, people who raise money 0 to 2 years before IPO, 2 to 4 years before IPO, and 4+ years before IPO. And if you see, for example, there's an RR Kabil here, which recently got listed. They had investment from a global PE fund from, called TPG Capital. There's Mankind Pharma, which got listed. They before that had raised private equity from an Indian fund called Chris Capital. Uh, there is Kims, which is healthcare. They again, a couple of years before listing had raised private equity from a global fund called General Atlantic, and so on and so forth. So these are well-known names, and these are the future champions, right? And as you can see, the value that has been created by these companies for investors who went in early, which are these private equity funds, have been fairly substantial. And thus for people who are participants in these private equity or venture capital funds. Okay. So this, I think, is data that people have found very helpful. We'll go a little further into this data. When you enter into these companies and you catch them at the right time, it's not that the value creation stops at the time of the IPO. Uh, so this is again a subset of companies from the previous slide. And just for convenience, we've looked at returns 0 to 5 years before IPO and 0 to 5 years after IPO. The periods are longer, but we've condensed it to this. Otherwise, the slides gets too big, right? And the simple point the slide is showing is, for strong companies which have built strong competitive moats, which are in high growth sectors, there is also substantial value creation that continues post IPO as well, right? So quality companies, continue to compound post listing. And now what are investors saying, right? A lot of this gets discovered at time of IPO. Can I use an alternate asset? Can I use private equity or late stage venture capital to enter these companies a little earlier and get a greater share of that value? And that's why, that sort of, is what brings into focus the role of private equity and the role of alternate assets. I think this is the other part which is important. And this is again mostly a culmination or a summation of questions that have come from various people, right? Which is, okay, we understand this is a big space. In fact, some people have also gone in and they've burnt their hands, right? So they're also, they're trying to understand, look, how can we rectify some of this? So how do you start your journey and how do you select your fund manager? Okay, so let's talk about starting journey and where should you begin. I think the first thing is have clarity on which asset class within alternates you want to play, right? So, and there could be growth equity, there could be venture capital, there could be real estate, I think, which was being spoken about in the session earlier. Each will have different risk reward relationships. Each will have a different class of companies, obviously, or assets that it's investing into, and they may have very different liquidity profiles as well, right? There is no right or wrong answer to this, but I think where the mis-selling and because and the lack of information sort of plays in is that people sort of enter a risk category which is they probably don't have a stomach for, and I think that's where problem starts, right? So, and in this, I think what we've seen is, for example, a lot of people have gone into venture capital without fully understanding it, right? And then what do they see that, look, there are a lot of mortalities, which is and in a venture capital portfolio, typically you will see that some companies will do well, but a lot of companies may not see light of day. Now, one thing to say that, but I think a lot of people have entered that asset category without understanding, and now they're going through that experience of seeing mortalities in the portfolio, and they can't digest that risk. Important to know that risk upfront. Similarly, people have gone into venture capital, let's say, and they've been promised liquidity in 3, 4, 5 years. Now that would rarely happen, right? In most cases, these companies, have a journey, they take time to build, and experience has shown that, look, liquidity will take fairly longer. So if your liquidity needs are, for a shorter duration, right? You one know that these are closed-ended products, right? So it will take time for money to come back. These are not listed products where you can click on a screen and get money back. Very different from mutual funds, etc., that people are used to, right? So Understand that, and then also match the duration to your own personal risk appetite, right? Is what I keep telling investors. As I said, these are long tenure products. So please understand most of these will be closed-ended products. If you see most of my career, I've worked with global private equity funds. These, would be 10 years in duration, sometimes 12 years in duration. Thankfully, in India, that's, you also have funds now which are, let's say 5, 6, 7 years in duration, which are then doing, let's say, slightly growth or late stage assets, right? I think those are a good place for people to start. But if you have the risk appetite, by all means go into a longer duration fund, but then, have the patience for, to let that the manager put that money to work for those underlying companies to grow and for money to come back. In the initial few years, right, it's a given that liquidity is low. So I think a lot of people have not understood this, or there's been misinformation, right? You're investing in a private company, it will take time to grow. These are closed ended. Most of these would say, you'd see liquidity either when these companies hit the capital market, or, when there are subsequent rounds where large investors are willing to buy out early investors. And that would take time, right? So be prepared for that. I think the third thing which is very important is diligence, right? So diligence your manager and diligence your organization very, very well. Okay. And there's a difference in that. Now, in a lot of cases, you would have individual fund managers or just a group of people coming together, right? And I think the level of diligence there is very different and should be focused on the team. The saliency on the team, how long have they worked together? How closely are their incentives tied to run this fund for, the 7, 8, 9, 10 years, whatever the fund duration is. Against that, you would also have funds which are, backed by larger organizations, like ourselves or some of the other larger mutual funds, or even, investment banks have come out with alternative products. I think, the degree of risk from a saliency standpoint is probably a notch lower there, because, you're not just betting on the manager, but you're betting on the organization, and, that the organizational machinery is standing behind the longevity and the saliency of that fund. But in which case you also have to sort of diligence that. So I think, there is still under diligence that goes into the selection of this, but, diligence your organization well and diligence your manager very, very well. I think, so those parts you have to understand. Then, I think once you've been through that journey and you figured out, okay, venture capital, real estate alternative, growth equity, etc., where you want to be, you fully sort of diligenced it. An organization, how do you evaluate a particular fund, right? And some of these, and these are coming from evaluation criteria that some of the best investors over a period of time globally have used, that they've invested in private equity funds globally. Okay. I think very important, number one is organization track record. So who is backing the fund? What's the organization, and what's the strength of the ecosystem that they bring, right? Private equity is not like listed market where there is codified research. There are many analysts covering companies. So you have to go deeper into how does your manager identify companies, how many deals are proprietary, right? Why? What's the evaluation framework? How are they conducting diligence? And more importantly, and this is probably the most important point that I'll make, right, which is how much capital have they returned to investors in their previous funds? Unfortunately, the track record in India for people giving back money in private equity has been very poor. I think raising money has been easy. People have been unable to. So there will be, as you see and you go deeper, you'll understand there are lots of funds which will sit on paper returns, which is MOIC. But the actual money back, which is DPI, is what you need to look at, right? Because, ultimately, I think that's where confidence gets built, and the lack of DPI is what creates problems in the ecosystem. So, focus on that and ask questions around, how much capital has been returned by the team, by the organization in previous funds. I think manager track record, team track record is obviously paramount. Check with relationships with investee companies, right? What companies have people invested in? How have their relationships been? A lot of people will make tall claims about, value add on portfolio companies, and the best way to ratify that is by talking to those portfolio companies. I think the next one, which again is given less importance, but it's probably one of the important indicators of success or ingredients of success, and that's just skin in the game, right? Which is how committed is that organization to that fund as part of the larger organization or the larger, and how important is that fund to the overall strategy of that organization, right? You will typically, often have fund managers running various kinds of fund, and there'll be a private equity fund which will be sort of, launched on the side. Uh, how much of the organization's resources, in some cases even capital, is devoted to that fund? These are questions to be asked, because skin in the game is extremely important. Remember that you're investing in a long-term product. The more aligned your interests are with the organization and the fund manager, the chances of success go up, right? So that's where skin in the game is important. Okay. Uh, Obviously, go deeper into strategy and approach, right? And I think, how much time are people spending on diligencing assets on the ground, right? Or is this sort of a team which is locked up in a room somewhere trying to do private equity or venture capital transactions? So, and you will find, all kinds of people. So I think strategy and approach is extremely important. And I would say the last bit to look at is life cycle experience. Uh, I think alternate assets, this is not a portfolio which you can track on a screen and you can exit when things go wrong, right? If you see a 5-10% correction, one, you don't see that because these are not listed securities, and exits are very difficult. So you need to have the confidence, right? And things will go wrong when you're investing for the long term. You are building pretty much businesses alongside some of the best entrepreneurs and business holders. It's never a straight line, right? Things go up and things go down. The real test is, has the manager and the organization had experience of handling tough situations, of getting money out of tough situations, right? So have they had the entire life cycle of experience, or are these people who've just spent the last 2-3 years only looking at the investment side? Have they worked with portfolios? Have they nurtured portfolios? And have they seen all kinds of exits, right? IPOs, strategics, have they seen tough situations? And that's feedback also that you will get from, again, investee companies, other investors, competitors, etc. But I think, the skin in the game and life cycle experience are sort of extremely important points as you're selecting your fund manager. So I think that's what I had to share. Just to recap, it's, it covered, why invest in alternates, and within that private equity, and within that, why are people liking growth equity versus other? Obviously no right or wrong answer. If you understand venture capital good enough, by all means, engage in that. And then, what are some of the things to keep in mind as you're beginning your journey, in terms of the nature of these products, the managers, and the different classes? And more importantly, we spoke about some of the important criteria, and this is obviously a very quick summary. We can, someday have a more detailed session, because I think this whole thing around how to evaluate a fund and fund manager can be a much longer topic.
So thank you so much for the lovely presentation, Ashish. We got a lot of insights. So uh, basically, I have one question, if you're okay, is that there are a lot of discussions that some of the companies are trading at a higher valuations when it comes to private equity, and some of them have given wrong examples also. Like they've given the example of Byju's, which is a manipulated sort of scenario. But otherwise, also there is this discussion going on. So your views on that, Ashish?
So if I understand the question, you're asking about valuations, and then the second part, if I may understand the question correctly.
Yeah. So valuation, that's the main point.
Yeah. So I think, look, that's where I was talking about the point on fund manager selection, right? It's very important, firstly, to diligence your fund manager in this. And unlike public markets where you can compare the data and open up portfolios and pretty much compare them to the market. Here, you actually, once someone says they've done something, you really need to do a lot of primary diligence to understand how that deal was done, etc. When you're selecting your fund managers. Um, the I think it's the real differentiation is on the process and the level of diligence that the fund manager is undertaking, right? So that's extremely important. I think the other thing, because that has happened, is obviously there's been a lot of mis-selling also, initially, as some of these products have come out, right? So, and specifically, I think what you were alluding to, both on valuation, if I understand, and the example you took is, especially on what's happened on the technology side of things right now. I think that's a place which, to some extent was on steroids for 3 years, right? Between let's say 2018 to 2021, that period, and that's cheap global money coming in, a lot of money being pumped into companies, valuations being skyrocketed, and you were seeing, everyone was sort of reading this news about valuations of companies, and everybody raising a next round every 3 months, 6 months, and doubling valuation, and a lot of FOMO set in for that, with that as well. Now, that game, unfortunately, the way it happens is when they rise up, and global markets have taught us that, right? If you look at the Asian financial crisis or the dot-com bubble in the US, global markets have seen these kind of cycles, right? And that money also disappeared equally quickly. Now, when that happens, obviously with a rising tide, everyone rises, right? Now, does that mean that every business is bad? No. I think the entrepreneurial ecosystem in India has created some fabulous businesses, right? Disruption has been, across the board, and you've seen categories get created which we could not think of, right? Look at food delivery or quick delivery of grocery, right? We all were sort of disbelievers on how big it could become, and today it's a massive sector and still growing at 50, 60, 70% per annum, right? Look at mobility, look at payments, etc., etc. So a lot of good work has happened and good businesses have got created. Unfortunately, when there's easy money, there'll also be obviously some companies which are of where business models could be questionable, right? And I think those will get sifted out as the easy capital is going away. So the market, yes, is going through that. Unfortunately, it will cause pain to some people, right? And especially people who came in through that FOMO element, saying, "Hey, I'll miss this bus. Let me just, without diligence, sort of get into these companies," or through managers who didn't sort of fully understand what was happening. So I think business model selection is extremely important, number one. Second, please understand the level of risk you're taking, right? If you're going into a venture capital portfolio, right? See, what does the venture capital portfolio look like, right? You'll have 25, 30 companies, 10 to 15 of them will not see light of the day. Now, people went into these funds but didn't understand this mortality, right? They were expecting it to perform like a mutual fund where every business should give you 20, 25% return. That will not happen, right? So understand that risk very well. If you're not ready to take that risk, do slightly late stage, do growth equity, and then go into venture capital. So diligence on the asset, understand risk and duration very well, and obviously then the third which I was speaking about is back the right manager, and that look at skin in the game, look at track record, look at life cycle experience, etc., etc. So but yeah, I think some of these problems caused, as I said, by a rising tide, and you will see some pain which will come out at the other end. But what you will also see is that the men will differentiate themselves from the boys. So you will see some very high quality business emerge from what we're going through right now as well.
Right. And the way things are shaping, as I said at the beginning of the presentation, is that now the growth in India is at the 46% growth in last 7-8 years. Started from 2.5%. So the exposure through AIFs and participating in private equity is always advisable, because then you are under the guidance of fund manager, and fund manager would evaluate on various parameters. Some companies extrapolate their numbers basis the growth assumption, which does not come true sometimes. So therefore you need a very, very strong processes in place so that you can keep a track of the whole thing, keep a check on these things. So all right, with that, I'd like to conclude the session here. Ashish, thank you so much for taking the time out, joining this session, and supporting this whole conclave.
Thank you, Vikas, for organizing it, and all the best to your organization as well. I keep hearing that you're doing wonderful things. All the best.
Thank you. Look forward to meet you.